Welcome to Macro Money. This is Ilya Spivak, head of global macro here at tastylive. Welcome to the show. We have been waiting for something to happen on the macro side of things all week. And today we are going to get the first real batch of economic data. Of course, a little bit ago, a few hours ago, we saw jobless claims numbers come out of the U.S. That was really the first piece of economic data. Those numbers are weekly. So we get those every week. That's not unusual. There was a sprinkling of weakness in those numbers, and the markets were responsive. They didn't like that we had those outcomes there, but as ever here on Macro Money, we are forward-looking, and we're going to aim for what the markets are going to do next. And what they're going to do next is they're going to finish out the week with a run of really key economic data, finally, that is going to give us a level of steer on where we are in the global business cycle. And as the screws tighten on growth and all this tightening comes in, I thought it'd be a good time, first of all, to look at what that data is going to look like. And of course, I'm talking about April's roundup of Purchasing Manager Index numbers. We'll talk about what those are. We mentioned them a lot on Macro Money. And with that, we are going to look at how this cycle has been developing from the turn after the recovery post-COVID through to tightening, through to its impact on growth, and now the specter of recession and how to trade it. What actually can be a strategy to find opportunity in a recessionary environment. So let's first begin with where we are, how this cycle works, and where it seems we are going. So this I've sort of dubbed phase one, and this is no textbook nomenclature. This is with you courtesy of yours truly. So this is not necessarily something that is going to be identically the same every time. It's not something that you'll find in a textbook described exactly this way. This is what we are experiencing here in the post-COVID recovery in this moment in global economic history. So what you're seeing here, the dark line is the Citigroup Economic Surprise Index. We look at it usually for groups of economies in the Eurozone and then individual economies in places like the US or China, Japan. What we're looking at here is a reshuffling where we're taking the index collectively for the G10 economies, the largest 10 economies. And what we're doing is we're saying for these developed market economies, what's been the flow of economic data? Has it been performing better or worse than expected? When it performs better, the index rises, again, relative to expectations, not in absolute terms. When it performs better, the index rises. When it performs worse, the index declines. And so the takeaway here is that on the way out of COVID, the index, of course, surges because economic data starts to do much better as we get the first bits of reopening, and indeed as markets stabilize with central banks' aggressive stimulus and government's aggressive fiscal firefighting efforts, we see that growth very quickly surges out of the COVID doldrums, and data starts to really outperform expectations. We can see the peak in that surge is July of 2020. It then takes 10 months for global purchasing managers to notice that the business cycle at least as far as data flow is concerned, appears to have turned a corner. What that orange line is a purchasing manager index composite. These are folks at various corporates that are typically polled by S&P Global. That's the biggest provider. Another one that we always talk about is the Institute of Supply Management. That's the one that focuses on the U.S. and Canada. China has its own official version of this that does their national PMIs. So what we're looking at is, in this case, an S&P Global survey where they go and they ask those people at major corporates that are in charge of purchasing. So in other words, they need to stock inventories. They need to know what the business is going to need ahead of when it's going to need it, and to have those things ready and to plan to have them set up ahead of time. So these are people whose very function necessarily is a forward-looking exercise on global demand. This is why this data is so valuable. It's a good anticipatory view of what GDP, or economic growth in simple terms, later ends up looking like for the most part. Nothing, of course, is ever a perfect one for one indicator, but it becomes very telling, at least where things are trending. In this case, the orange line is developed markets. So I've left emerging markets off the table here. They have their own dynamics. This is developed markets. So we see the economic data from those developed markets, the G10, start to turn 10 months before these people whose job it is to be forward-looking notice, and their sentiment starts to shift. And their assessment of what's going on, and because this is a composite, it captures both manufacturing and service sector industry, which is essentially everything that's non-farm, and so the overwhelming majority of these economies. Agriculture makes up a pittance at this point of GDP generation, of growth generation, with services being easily the lion's share, manufacturing behind it. If you had to kind of guesstimate it, you could say most economies are about 70% services, 20% manufacturing, 10% ag. In some economies, it's more dramatic, 75% services, maybe 22% manufacturing, and 3% ag. Even for those with a significant agriculture sector like the U.S., ag is relatively small as a contributor to GDP. So what you're looking at here is the composite of services and manufacturing. And you can see the people doing the forward-looking work at these firms notice the turn with about a 10-month lag. Now, phase two, next step, global growth starts to actually reflect what's going on. So you can see here that there's that same PMI gauge, and 10 months after it notices and starts turning, you start to get the downturn in total global trade volume. This is collective global exports and imports added together. So it gives you overall kind of cross-border business activity. Notice another 10 months elapses before these people whose organizations rely on them to be forward-looking notice, and what they notice actually seems to occur. The rubber actually meets the road. You're starting to actually see the decline in economic activity 10 months later. And then another 7 months after that is when global inflation actually takes cues from the slowdown in growth and starts to go down. So lag here from when we notice things are starting to turn, economic data starts to underperform. Hold that date in mind, that's July of 2020. And when inflation actually starts to turn, that's 25 months later. That's October now of 2022. That's over 2 years later. And so what you are watching then is this kind of slow progression in the cycle. Notice, by the way, that world CPI here still very elevated and above most central banks' targets at about 7 to 8% overall. And so what you're looking at is still central banks that have incentive to continue fighting inflation and keep this process going at a time when growth has already started to turn, with some time already elapsing in the turn, significant time, as a matter of fact. So central banks remain in inflation fighting mode, and of course they're aware that there's lags and they're ostensibly going to respond accordingly, but they are still very much in this inflation fighting phase of things well into when the downturn actually is already underway and some of the way advanced already. With that backstory, we are looking today at updated PMI numbers from the US, from the UK, and from the Eurozone. Collectively, that's almost half, 42% of global GDP. So we are going to be looking at something that is, of course, tremendously impactful for the overall story, and how things are going in these economies will be critical. It is important to note here that the US is nearly a quarter of the entire whole. So the UK, the Eurozone collectively almost a fifth, the US by itself almost a quarter. And of course, in that rest of world number, that's 58%. There's all kinds of major economies in there, of course, notably China. If we were to include China in the US and Eurozone mix, we would be looking at close to 60-70% of global GDP. So obviously the lion's share of that yellow bar there is China when we look at single contributors. Today, though, the PMI numbers that are going to be with us are from the three that we have listed. So let's see how those things are going. The first numbers we're going to get are out of the Eurozone. We can see here we are looking at manufacturing still in contraction territory. Just to remind us on how PMIs work, the center line is 50. That's neither growth nor expansion, nor contraction, rather. And below 50 is contraction, above 50 is expansion. The higher you go above 50, the faster the expansion. The lower you go under 50, the faster the contraction. So distance from 50 denotes speed. Above it is growth, below it is contraction. So what we see here is we see manufacturing still in contraction mode, services, and thereby the composite index in expansion, because services, as we just mentioned, are a much bigger piece of this whole. And in fact, you can see here, services and the composite basically move in lockstep because services is the driving force. Both of them are expected to be in expansionary territory north of 50, but you can see mild slowdown on both counts. For manufacturing, there is a bit of an uptick, but we're still in contraction territory. So we're shrinking, is the expectation telling us, but at a slower rate. Next, we'll get the UK. Here, fairly steady, and a similar story to what we see in the euro area. So expansion in services, and thereby expansion overall, but perhaps a little bit of a slower pace. For manufacturing, again, still in contraction mode, but perhaps a little bit of a moderation there on the pace of that contraction. Then the US. Here things look a little bit more troubling. It is, again, a very similar configuration. We have manufacturing is shrinking. We have services and thereby the composite in positive territory, but we're looking at expectations of a decline on both counts. So here, unlike what we see in Europe, unlike what we see in the UK, we are looking at some amount of deceleration or some amount of movement in the adverse direction across all three of these numbers. So let's summarize what we're looking at here. For the Eurozone, a little bit of improvement in manufacturing, but still shrinking. Services going down, net result, stasis. Composite looks like it's expected to be unchanged. UK, improvement in manufacturing, but again, still shrinking. Services getting worse, composite, even. For the US, we have deterioration across the board. Manufacturing slower or shrinking faster, as it were, and slower growth on both services and composite. So this immediately seems to jump out and say, on net, everybody seems to be having trouble with manufacturing, but at least in Europe, it's getting a little bit better. Services seems to be getting soggier everywhere, so perhaps some of that surge that's been keeping services afloat post-COVID is fading. And the U.S. seems to be more sluggish than elsewhere. This naturally brings us to a conversation about recession risk. And here, the dynamics are very curious indeed. This is from a survey of economists conducted by Bloomberg. It's updated weekly, if memory serves. And what you see here is an interesting situation where the odds of a recession in Europe and in the UK have actually declined recently, whereas those in the US have at best stayed even keel. So the odds of a recession in the US now, 65% within the next year. The odds of a recession in the UK, also 65%, but that's down from around 90, looking back a couple months. In the Eurozone, you get the most dramatic result. You have the odds of a recession down to 45%, so actually lower than even, lower than 50-50. So by a narrow margin, markets now expect that the UK is less likely than not to have a recession, down from around 80 just recently. In the US, you never went up to 80, you never went up to 90, but you're holding near the highs of 65, and you don't seem to be going anywhere very quickly off this level. This seems to echo what we saw here, which is that there are signs of improvement in the Eurozone tenuous though they are. There are signs of improvement in the UK, tenuous though they are. In the US, we seem to be fading. And in the US, there seems to be no downturn cyclically aligned with Europe. In the likelihood of a recession, actually, it seems like we are going the other way. This, of course, raises an important question. Number one, what happens if there is a recession? What happens if there is a recession in more than one place at the same time? And what does it mean that the U.S. is looking particularly sluggish? Now, to some extent, this makes sense. The U.S. has had the most aggressive rate hike cycle of really all of the major economies, and certainly the emerging ones. They've not had nearly the rate hike cycle that the major economies have had. And if you take just a quick step back, you can understand why. Through the COVID stimulus bonanza, it was developed markets, and mostly the U.S., that dumped piles and piles of fiscal and monetary stimulus onto markets, and the U.S. was front of the line on doing that. So not surprisingly, most of the inflation was created in developed markets, and in particular the U.S., though of course the inflation situation in the U.S. is now much more benign than it is in Europe. But the reason it's much more benign is because the tightening in the U.S. has been much more aggressive than in Europe. And so we've gotten to this more benign inflation by inflicting more economic pain than Europe has for now. And so this then ends up being the key question. Because as we just saw moments ago, the U.S. is a quarter of global GDP. The UK and the Eurozone may be close to a fifth. And of course, these are data going back to 2021, so you don't want to get too precious about 1 percentage point or two here or there. This has surely evolved a little, probably not in a great way, not in a big way. Maybe you've gone from 24 to 25 or 24 to 23, something like this. The upshot of this will not have changed. But what you're looking at is essentially the possibility of a recession and the appearance of outsized weakness in the biggest single part of the pie. And of course, where that brings us, once again, is here. Which assets do well during not only a recession, but maybe specifically a U.S. recession, whereby the U.S. underperforms other major economies? This is once again that dollar smile framework that we have from economist Stephen Jen, formerly of Morgan Stanley. Now he runs a research outfit and fund called Horizon. What you're looking at here is the relationship that the U.S. dollar has to relative U.S. economic growth. On the x-axis is the spread between U.S. GDP growth and the G7 average. On the y-axis, you have the U.S. dollar, in this case, the DX future. And what you see is that when the U.S. significantly outperforms, the dollar gains. You can see the orange line approximating the scatter plot here and looking like a smile. You end up on the right side of that. What that's telling you is that when you have an outperforming U.S. economy, let's say that, you have a better rates story there. More growth means more inflation, means more rate hikes, means owning the dollar becomes more attractive because, as we've said many times before, one person's borrowing cost is another's lending income. So if the cost to borrow dollars is rising, then the income to be had from lending dollars is rising too, which means owning dollars starts to become an attractive investment proposition. So in this situation, you have rising yields because of stronger growth, which gives you stronger inflation. Stronger dollar necessarily follows, and that's what happens at that end. But then we're concerned in our conversation about recession with the other end, where the U.S. underperforms. Because the U.S. is such a commanding part of that global pie, because it's basically a quarter of all global growth, the likelihood that everybody goes down with the ship is significant. If the U.S. is in recession, that's a very big blow to overall global demand, a very big blow to the capacity for companies to extract earnings, thereby a catalyst lower for financial markets, for stocks, for cyclical commodities like crude oil or copper, say, for cyclically minded currencies like the Australian dollar, the Canadian dollar, for any manner of higher risk assets, and in particular cyclical assets. But when people cash out of those assets because they think the environment is turning grim, what's the form of cash that they cash out into? Well, if they're concerned about volatility and consternation and recession, needless to say, they're going to go into the most liquid thing, because that's going to be the least reactive. The more liquid something is, the less volatile it is. And nothing is more liquid than the US dollar. As a matter of fact, there is no asset in the known universe, as far as we're concerned here, as far as we know, that is more liquid than the US dollar. So when people cash out, that's where that capital in large part is going. Not the only place, certainly. For example, we often talk about the trade-off between stocks and bonds. When there's consternation, people go to bonds. But treasury bonds, which are the go-to sort of source of safety in this kind of narrative, you need dollars to buy those. Now, of course, other countries sell debt of their own as well. But it is U.S. Treasury bonds that often are seen as conferring the most safety, because the U.S., debt ceiling shenanigans notwithstanding, is at the least threat of default, because it's sitting on the richest tax base really in the history of humanity when you consider the size. And so if the U.S. needed to pay its debts, there's no question. We could certainly legislate a debt ceiling for ourselves to tie some limbs behind our back. But as far as having the money to pay, being able to service the debt, there's no question. And so, not surprisingly then, capital goes for that liquidity in a difficult situation. And so, if what we're looking at here, and if this PMI data reinforces that what we're increasingly seeing is building recession risk, and we've gotten to that point in the sequence, and the lags are now bringing us to a place where, despite inflation still being elevated, growth is starting to buckle, with the U.S. as the recipient of the most tightening out front. This might well be a recipe for the U.S. dollar to recover and to launch the next leg higher. And that is Macro Money for today. This is our last show for this week. Thank you very much for tuning in. We're here Monday through Thursday every week, right after overtime, with our friend Chris Vecchio, head of futures and Forex here at Tasty Live. I'm back on with Chris for Futures Power Hour on Fridays. I'm on with Tom and Tony for First Call Sunday evenings at the weekly market open in Asia. Outside of those, you can follow me opining on Twitter at Ilya Spivak. Don't mind the absence of the blue check mark. That's Elon's doing as of today. I am still me. So by all means, do continue to follow that at Ilya Spivak. That is still yours truly opining. Good luck out there, everybody. Happy trading. Take care.